Welcome, I'm Ernie Goss, research faculty member here at the Craig School of Business at California State University, Fresno, reporting as we always do on the first business day of the month for our economic conditions. That's the economic conditions of the San Joaquin Valley. That's the four-county area that composes the Fresno metropolitan area. So here we are again to report on what do the numbers tell us about the four-county, the San Joaquin Valley economy going forward. Well, good news. The overall index was above 50 for the 20th straight month. And of course, the index ranges between 0 and 100. 50 is growth neutral, above 50 is growth positive. And of course, it moved down a bit from 57.1 down from 58.3. Now it's down, but 57.1 is a pretty good reading. I would call that a healthy reading, especially if you compare it to the U.S. number, which comes out later on this morning. And here I've brought a chart with me, and you see the chart here where we're charting. I'm charting the overall reading for the U.S., which is in blue there, and red, which is Fresno, the Fresno area, the San Joaquin Valley. And you see the number is in very positive growth range, well above the national number. Again, the national number will come out later on this morning. I expect it to be 52-ish, I'll call it. And of course, again, the San Joaquin Valley number, well above that at 57.1. The inflation gauge declined from 60.2 to 56.8. That's pretty good news, although the Fed's looking for a little bit more inflation. Now again, this is a wholesale inflation gauge, which is again indicating modest inflationary pressures. The employment gauge falls from 62.6 to 54.8 in July. Again, it's a pretty good growth range, not as healthy as the overall reading, but still good. We had gains in manufacturing, and that's very good for the four-county area, the San Joaquin Valley. We're going to see growth continuing there. This will spill over into the broader economy in the weeks and months ahead. So I'm expecting, our model is predicting positive growth for the next 3 to 6 months. Wholesale trade doing very well. Construction pullback there, not as strong as we've seen in the past, and of course that's not what we're seeing in the national economy where construction is picking up. Average weekly wages, not good for the San Joaquin Valley. Of course, that's what we're seeing at the national number. As all you viewers know, wages just aren't growing at the pace we need to see. In fact, they're flat from this time last year for the San Joaquin Valley. We asked the businesses, the supply managers, the business leaders about how a Federal Reserve rate hike in September, which I expect, how that'll affect their business. 1/3 expect that to have a negative impact on them, on their business. 1/3. 2/3 said no impact. So most of the businesses say this Federal Reserve rate hike, which is probably going to be 25 basis points or 1/4%, is not going to have much of an impact. Now, those are our findings for last month. What should you, as an investor, as a business person, as a citizen, be on guard for, will be watching for next month, and that's this month of August, I should say. Look at the jobs report, which comes out this Friday, August the 7th. That'll be the jobs report for July. Keep an eye on that number. Look at the number. Look at the number of full-time jobs versus part-time jobs. That's an issue. Look at the wage number underneath it all. See how wages are growing or not growing. Core CPI. Now, what is the core CPI? Consumer Price Index. That's the CPI Xing out food and energy. Those are the volatile sectors, food and energy. That number has been growing year over year at 1.8%. If that begins ticking up, which I think it will begin ticking upward, perhaps to 2%, then you can guarantee a rate hike in September. Right now, a rate hike is, in my view, is more likely, but there is a possibility of no rate hike. You see that number ticking up to 2, to 2.5, to 2.4. Somewhere in that range, you're going to get a rate hike. CaseShiller Home Price Index, keep an eye on that number. That's been the last number we got from May, that was April to May, was a decline in housing prices nationwide. Now we see another decline, that's going to be a real warning signal. Now even with the decline, we saw growth at about 4 to 5% in prices. Of course here in California, a little bit better than that. We're seeing, particularly in, say, San Francisco, where we're seeing really much stronger growth than 4 to 5%. Now, what are the risk factors going forward? In other words, what should really thwart all these very good economic indicators for the San Joaquin Valley? First off, the Chinese stock market. Big deal. Now, it's a small market, but it's a big deal. Now, why is it a big deal? It's a bigger deal in my judgment than a lot of other economists think, because I think it could spread to our stock market. And what does that mean? Our stock market, the U.S. stock markets, I should say, markets, that would be the New York Stock Exchange and, of course, NASDAQ. Looking at those, they're priced for perfection. So if you get something in the Chinese market and it does cause U.S. investors to pull back, it could be, we could see stock prices in the U.S. tumble. Now, I don't expect that, but I'm saying it's a risk factor. And finally, another risk factor, the final risk factor, I think, of wages. As I said, on this Friday, we're going to have a jobs report. If that wage number comes in much lower than what we are expecting, it's been coming in about 1.8 to 2% growth year over year. If that number should really be getting lower, that would be a real, I think, a risk factor for the stock market, and it would help the bond market. Of course, bond prices would go up and yields would come down, interest rates would actually come down, and the Federal Reserve might delay a rate hike. I think that's a mistake. I think the Federal Reserve should be raising rates even with these not such good national economic numbers. Now, again, the Fresno numbers, our San Joaquin Valley numbers are very good, and I expect that to spill over in the weeks and months ahead to the broader economy. Well, that's it, folks. Thanks for tuning in here today for our July report, and until next month, that would be September the 1st, when I'll be coming back to tell you what's going on in the August survey. The August numbers will be coming out September the 1st, the first business day of September. Until we meet again, may your economic cup runneth over. Thank you.